0x Protocol. 0x is a protocol that allows people to trade tokens on the Ethereum blockchain through decentralized exchanges, DEXs. It uses smart contracts to facilitate the exchange of tokens between users by creating a trade and automatically executing the exchange. 0x is open source and decentralized, meaning anyone can use it to create a DEX for peer-to-peer token exchange. %51 attack. A 51% attack is when a single entity or group controls more than 50% of a blockchain's mining power, allowing them to disrupt the network's normal functioning, such as double spending or reversing transactions. It requires a lot of computing power, which could be gained through specialized mining hardware or coordinated attacks across multiple mining pools. While it is a major vulnerability, it is uncommon because it is difficult for one entity to acquire a large enough share of the mining power to carry out the attack in a decentralized blockchain. Airdrop. An airdrop is when a cryptocurrency is distributed for free to a large number of wallets. It is often used as a marketing strategy to increase the adoption of the cryptocurrency. Airdrops can be given to users who hold a different cryptocurrency or to users who perform certain actions, such as following the project on social media. Airdrops are free and do not require any investment, unlike an initial coin offering, ICO, where investors contribute funds in exchange for a new cryptocurrency. Algo Trading. Algorithmic trading, or algo trading, is when computer programs are used to automatically trade cryptocurrencies on exchanges based on predefined rules. It can be used for different strategies, like market making and trend following, and is often used by professional traders to take advantage of small price movements and trade frequently. Algo trading can be efficient and reduce the risk of human error, but it can also be vulnerable to cyber attacks and requires a lot of expertise to set up and maintain. Algorithmic Stablecoin. Algorithmic stablecoins are cryptocurrencies that are designed to have a stable value compared to a specific asset or group of assets. For example, a stablecoin might be pegged to the value of the US dollar and use algorithms to automatically buy and sell the stablecoin to maintain its value. Algorithmic stablecoins can provide stability and a convenient way to transfer value between different currencies or assets, but they may not always maintain their value accurately and could be vulnerable to cyber attacks. All-time high, ATH. ATH stands for all-time high and refers to the highest price a cryptocurrency has ever reached. The all-time high can show a cryptocurrency's market performance and be used to measure its progress. If a cryptocurrency consistently reaches new all-time highs, it may be a sign of strong market demand and growth. If it hasn't reached a new all-time high in a long time, it may be a sign of stagnation or decline. All-time low, ATL. ATL stands for all-time low and refers to the lowest price a cryptocurrency has ever reached. The all-time low can show a cryptocurrency's market performance and be used to measure its progress. If a cryptocurrency consistently reaches new all-time lows, it may be a sign of weak market demand and declining interest. If it hasn't reached a new all-time low in a long time, it may be a sign of stability or growth. Reaching a new all-time low does not guarantee future failure, and it is important to carefully consider the risks of investing in any cryptocurrency. Allocation. In the cryptocurrency market, allocation refers to the distribution of an asset or resources among different parties. For example, it can refer to the distribution of a new cryptocurrency during an initial coin offering, ICO, or the distribution of mining rewards among miners on a proof-of-work blockchain. Allocation is important because it affects the distribution of power and the stability of the network. Alpha version. An alpha version of a cryptocurrency or blockchain platform is an early version being tested by the project's developers. It is usually released to a small group for feedback and to find bugs before the final version is released. Alpha versions are not meant for the general public and may not be fully functional or stable, generally not recommended to use or invest in them. Altcoin, alternative coin. Altcoin refers to cryptocurrencies that are alternatives to Bitcoin. There are many altcoins with different technologies and features, like being faster or more private. There are many altcoins available, but it is important to consider the risks before investing in any of them. Annual percentage rate, APR. APR stands for annual percentage rate and refers to the annualized return on an investment in a cryptocurrency as a percentage. To calculate APR, you need to know the initial investment, final value, and fees or expenses. Dividing the difference between the final value and initial investment by the initial investment and multiplying by the number of days in a year gives the percentage return on the investment over a year. For example, if you invested $100 and after a year it was worth $120, the APR would be 20%. APR is just one way to measure investment performance and doesn't consider other factors like risk or volatility. Annual percentage yield, APY. APY stands for Annual Percentage Yield and refers to the annualized return on an investment in a cryptocurrency, including compound interest. To calculate APY, you need to know the initial investment, annual interest rate, and how often compound interest is paid per year. APY is just one way to measure investment performance and doesn't consider other factors like risk or volatility. Anti-money laundering, AML. AML stands for Anti-Money Laundering and refers to laws and regulations designed to prevent, detect, and report money laundering activities. Money laundering is the process of disguising illegal funds as legitimate. Cryptocurrencies can be used for money laundering because they are anonymous and hard to trace, so AML regulations in the cryptocurrency industry are meant to identify and prevent illicit activity and ensure that exchanges and financial institutions follow relevant laws and regulations. These regulations often require financial institutions to have customer identification and verification procedures, transaction monitoring, and suspicious activity reporting. API. APIs, or Application Programming Interfaces, are used in the cryptocurrency industry to access data from exchanges, wallets, or other blockchain systems. For example, a cryptocurrency exchange may offer an API for developers to access data on the exchange's order book, trade history, and other information. APIs are also used in the development of cryptocurrency wallets, which allow users to store and manage their digital assets. APIs enable the creation of various applications and tools for the cryptocurrency industry. Arbitrage. Arbitrage is a way to make money by buying and selling an asset to take advantage of price differences. In the cryptocurrency market, this means buying a cryptocurrency on one exchange for a low price and selling it on another exchange for a higher price. Arbitrage can be risky because it involves analyzing market conditions and executing trades quickly. It can also be affected by fees, withdrawal limits, and market volatility. Arbitrage is generally only suitable for experienced traders. ASIC. ASICs are specialized computer chips used for mining cryptocurrency. They are more efficient and powerful than regular computer chips and are used in mining rigs. They have largely replaced regular chips for mining, but their high cost has made it harder for small miners to compete. Ask price. The ask price is the lowest price a seller is willing to sell a cryptocurrency for. It is determined by the demand and supply of the cryptocurrency in the market. The spread, or difference between the ask price and the bid price, represents the cost of trading the cryptocurrency. The ask price is a factor to consider when buying or selling a cryptocurrency because it affects the cost and potential return on the investment. Atomic swap. An atomic swap is a way to exchange one cryptocurrency for another without using a centralized exchange. It uses smart contracts to automatically exchange the cryptocurrencies based on predefined terms. This can be faster and cheaper than traditional exchanges, and it can also increase privacy and security. Atomic swaps are not yet widely used. Audit. An audit is a review of financial or technical information to verify its accuracy and integrity. In the context of cryptocurrencies, audits can be conducted for various purposes, such as assessing the financial health of a cryptocurrency company, ensuring compliance with laws and regulations, or verifying the security and integrity of a cryptocurrency's technology. There are different types of cryptocurrency audits, including financial audits, security audits, and code audits. Financial audits review a company's financial records and transactions to ensure their accuracy and compliance. Security audits examine a cryptocurrency's security measures and protocols to ensure they are effective. Code audits review the source code of a cryptocurrency or blockchain to identify and resolve any issues. Cryptocurrency audits are important for ensuring the accuracy, security, and integrity of financial and technical information in the industry. Automated Market Maker, AMM. An automated market maker, AMM, is a decentralized exchange, DEX, that uses algorithms to set prices for cryptocurrency trades and facilitate them based on supply and demand. AMMs operate on a blockchain and use smart contracts to match buyers and sellers. They do not have a central authority or order book, and they typically use a liquidity pool to facilitate trades. AMMs offer some advantages over traditional centralized exchanges, such as being decentralized and not requiring users to deposit their assets with a central authority. However, they may also have some disadvantages, such as lower liquidity and less transparent pricing. Bag. The term bag in cryptocurrency refers to a large amount of a specific cryptocurrency that a person owns. It is often used when discussing investing in cryptocurrency, where people may buy and hold a lot of a specific cryptocurrency in the hope that its value will increase. If a cryptocurrency is not doing well or has decreased in value, the person owning a lot of it may be called a bag holder. Bank run. A bank run is when many people try to withdraw their money from a bank at the same time because they think the bank may not be able to pay them back. In the context of cryptocurrencies, a bank run could refer to a situation where many people try to sell their cryptocurrency quickly because they have lost confidence in its value or stability. This can cause the cryptocurrency's value to drop and potentially harm trust in the entire cryptocurrency market. Basket. The term basket in the context of cryptocurrencies refers to a group of different cryptocurrencies that are bundled together for investment purposes. The goal of investing in a basket of cryptocurrencies is to reduce risk by spreading investments across multiple cryptocurrencies. This can help to prevent significant losses if one of the cryptocurrencies performs poorly. It is important to carefully choose which cryptocurrencies to include in a basket, as the performance of each can vary greatly. Bear. In the world of cryptocurrencies, the term bear refers to a market trend where prices are falling. A bear market is a market where prices are generally decreasing, and is often linked to negative sentiment among investors. The term bear is the opposite of bull, which refers to a market trend where prices are rising. Bear market. A bear market in the world of cryptocurrencies refers to a market trend where prices are falling. This is often linked to negative feelings among investors and a decrease in the value of cryptocurrencies. Bear markets may happen for different reasons, such as negative news about a specific cryptocurrency, changes in government rules, or a lack of confidence among investors. Bear trap. A bear trap in the world of cryptocurrencies refers to a situation where people expect the price of a specific cryptocurrency to keep going down, but instead it starts to increase. This can happen when people who expect the price to decline are trapped in their positions when the price starts to rise. Bear traps may occur when there is a sudden change in market sentiment or when new information becomes available that causes people to change their expectations about the price direction. BEP-2 Protocol. BEP-2 is a blockchain protocol used by the Binance Chain, a decentralized exchange platform created by the cryptocurrency exchange Binance. It is a flexible and scalable protocol that can support various uses, such as issuing and trading digital assets and building decentralized applications. It is built on top of the Tendermint consensus engine, which allows for fast transactions and low fees. BEP-2 uses BNB, Binance Coin, as its main value transfer token and requires all transactions on the Binance chain to be conducted using BNB. It is open source and developers can use it to create their own digital assets and decentralized applications on the Binance chain. BEP-20 Protocol. BEP-20 is a technical standard for tokens that are built on the Binance Smart Chain, a blockchain platform created by the cryptocurrency exchange Binance. It is based on the ERC-20 standard, which is a commonly used technical standard for tokens built on the Ethereum blockchain. BEP-20 tokens are interoperable and can be easily integrated with other platforms and systems that support the Binance Smart Chain. They can be used for various purposes, such as representing a digital asset, a utility token, or a security. BEP-20 tokens are created and managed using smart contracts, which are self-executing contracts written in code, and can be traded on decentralized exchanges and stored in wallets that support the BEP-20 standard. BEP-721 Protocol, BEP-721 is a technical standard for non-fungible tokens, NFTs, that are built on the Binance Smart Chain, a blockchain platform created by the cryptocurrency exchange Binance. It is based on the ERC-721 standard, which is a commonly used technical standard for NFTs built on the Ethereum blockchain. NFTs are unique digital assets that represent ownership of a specific item or piece of content, and cannot be exchanged for other tokens or assets on a one-to-one basis like traditional cryptocurrencies. Examples of NFTs include digital art, collectible items, and virtual real estate. BEP-721 NFTs are created and managed using smart contracts, which are self-executing contracts written in code, and can be traded on decentralized exchanges and stored in wallets that support the BEP-721 standard. Beta. A beta version of software is a version that is still being developed and has not yet been released to the public. It is made available to a small group of testers or users to gather feedback and identify any bugs or problems before the final version is released. In the context of cryptocurrencies, a beta version of a cryptocurrency application or platform is a version that is still being developed and has not yet been released for public use. Beta versions may also be made available to a limited group of testers or users for feedback and bug identification. Beta versions are usually not as stable as final releases and may have bugs or other issues that have not yet been fixed, so it is generally not recommended to use them for important applications or handling large amounts of value. Bid price. The bid price is the most someone is willing to pay for a cryptocurrency. The ask price is the least someone is willing to sell it for. The difference between these two prices is called the spread. When a trade happens, it happens at a price between the bid and ask. The bid and ask prices can change a lot and are affected by things like market demand and news events. Bitcoin dominance. Bitcoin dominance is the percentage of the total cryptocurrency market value that is made up by Bitcoin. Bitcoin is the most well-known and oldest cryptocurrency and has typically had the largest market value. Bitcoin dominance is often used to compare the relative strength or influence of Bitcoin to other cryptocurrencies. The high level of Bitcoin dominance means that Bitcoin is a major player in the cryptocurrency market, while a low level may mean that other cryptocurrencies are gaining popularity or market share. Bitcoin dominance can change and be affected by factors such as market demand, government regulations, and news events. It's important to remember that Bitcoin dominance is just one way to compare the relative strength or popularity of different cryptocurrencies, and should not be considered the only indicator of the overall health or performance of the cryptocurrency market. Bitcoin Pizza. On May 22, 2010, a programmer named Laszlo Hanich made the first recorded purchase using Bitcoin by buying 2 large pizzas from a Papa John's restaurant in Florida for 10,000 Bitcoins. At the time, the value of Bitcoin was relatively low, but over the years it has significantly increased in value. Hanich's purchase of the pizzas has become a well-known event in the history of Bitcoin, known as Bitcoin Pizza. The term Bitcoin Pizza is often used to highlight the significant increase in the value of Bitcoin over time and as a reminder of the risks and volatility of investing in cryptocurrencies. Black Swan. A Black Swan event is an unexpected event that has a big impact on markets or industries. In the world of cryptocurrencies, a Black Swan event could be a sudden change in the value of a cryptocurrency, a major hack or security breach that affects many cryptocurrency users, or a regulatory change that impacts the use or trade of cryptocurrencies. Black Swan events are hard to predict and can have serious consequences for those invested in or involved with cryptocurrencies. Block. In cryptocurrencies, a block is a unit of data on the blockchain, a digital record of transactions. A block includes multiple transactions and, once added to the blockchain, cannot be changed. Blocks are connected in a chain and show a history of all transactions on the blockchain. Miners, using specialized computer hardware, create new blocks by solving math problems and adding them to the blockchain through a process called mining. Miners are rewarded with cryptocurrency for successfully solving a block. Block reward. A block reward is a reward given to miners for successfully adding a block of transactions to the blockchain through the process of mining. The reward incentivizes miners to secure the network and is paid in the cryptocurrency being mined. The amount of the reward can vary. For example, the block reward for Bitcoin started at 50 BTC per block and is reduced by half every 210,000 blocks. The current block reward for Bitcoin is 6.25 BTC per block. Block size. The block size in cryptocurrency refers to the maximum amount of data that can be stored in a block on the blockchain. This limit is typically measured in bytes and varies among cryptocurrencies. For example, the block size limit for Bitcoin is currently 1 megabyte. The block size limit can prevent spamming of the network and help blocks propagate quickly, but it can also limit scalability by restricting the number of transactions processed per block. The block size limit has been a topic of debate in the cryptocurrency community, as some believe it should be increased to allow for more transactions per block. Block time. Block time is how long it takes for a new block to be added to a blockchain. It can vary for different cryptocurrencies and is influenced by the difficulty of the math problem that miners are trying to solve. Block time affects the performance and security of the blockchain. Blockchain? The blockchain is a list of all the transactions that have happened on a cryptocurrency network. It is made up of blocks that hold records of multiple transactions, and once a block is created, it is added to the blockchain permanently. The blockchain is not controlled by any one person or group and is maintained by a network of computers working together. This makes it hard to change or censor. The blockchain is a secure way to keep track of cryptocurrency transactions. Blockchain Explorer, CoinScan websites. A blockchain explorer is a tool that lets you see information about transactions on a blockchain. You can use it to find out details like how much cryptocurrency was transferred, who sent and received it, and when the transaction happened. Blockchain explorers can be used for things like checking the balance of a cryptocurrency address or seeing the status of a transaction. There are many different blockchain explorers for different cryptocurrencies, and you can usually use them through a web browser. Some examples of blockchain explorers are blockchain.com, Blockstream Explorer, and Etherscan. Blockchain Trilemma. The blockchain trilemma is about the balance between three important qualities in a blockchain: security, scalability, and decentralization. It can be hard to have all three of these at the same time, because one may make the others harder to achieve. For example, a blockchain that is very decentralized and secure may not work as well or be able to handle as many transactions as one that is less decentralized. The blockchain trilemma is a problem that designers of blockchain networks need to solve in order to find the right balance between these qualities. Bollinger Band. Bollinger Bands are a tool that some cryptocurrency traders use to try to predict price changes. They are lines on a chart that show how much the price of a cryptocurrency is likely to move, based on its past behavior. Bollinger Bands can help traders see when the price might be too high or too low, which could mean that it might change direction soon. It is one of many tools that traders can use to make decisions about buying and selling cryptocurrencies, but it is not the only thing they should consider. Bots. Cryptocurrency bots are computer programs that do things automatically on the internet. There are different types of bots for different tasks, like trading, making money from price differences between exchanges, and gathering information about the market. Some people use bots to trade for them, while others use them to help with their own trading. Bots can be helpful, but they can also make mistakes or be hacked. It's important to be careful when using bots. Bounty. A bounty is a reward that a cryptocurrency project gives out for doing a certain job or reaching a certain goal. For example, a project might give a bounty for finding and telling them about a bug in their software or for making a new feature for their platform. Bounties can be given in different forms, like cryptocurrency or tokens. They can help a project get people to help them and achieve their goals. However, it's important for projects to think carefully about the terms and conditions of their bounty programs and make sure they match their goals and values. Bridge. A bridge is a tool that lets different blockchain networks talk to each other and exchange assets. It can be used to move assets between different versions of the same cryptocurrency or between completely different cryptocurrencies. Bridges can be helpful for things like using different features on different blockchains or making transactions between them. Bug exploit. A bug exploit is when someone uses a weakness or flaw in cryptocurrency or blockchain software to gain unauthorized access or change the system. This can be harmful and allow someone to steal money or disrupt the network. To prevent bug exploits, it's important for cryptocurrency projects to have good security practices and to check for vulnerabilities. Some projects also offer rewards for finding and reporting bugs to help fix them. Bull. A bull market in cryptocurrency is when prices are going up or are expected to go up. This is a good time for investors and is often associated with people buying more. A bear market is the opposite and is when prices are going down or are expected to go down. This is a bad time for investors and is often associated with people selling more. These terms come from how bulls and bears attack their prey. It's important to remember that markets can be unpredictable and that past performance doesn't always predict the future. Investors should always do their own research and think carefully about the risks and potential returns before making any decisions. Bull market. A bull market in cryptocurrency is when prices are going up or are expected to go up. This can be because of things like a strong economy, good market conditions, or more people wanting a certain cryptocurrency. Investors may feel good about making investment decisions and may try to make profits by buying. A bear market is the opposite and is when prices are going down or are expected to go down. This can be because of things like a weak economy or not as many people wanting a certain cryptocurrency. Markets can be unpredictable and past performance doesn't always predict the future. Bull trap. A bull trap in cryptocurrency is when people think the market is going up, bull market, but it actually goes down, bear market. This can happen when there is a sudden change in market conditions or when there is wrong or manipulative information. To avoid falling into a bull trap, investors should be careful and consider all information before making decisions. Burned. Burning, in cryptocurrency refers to the process of permanently removing coins or tokens from circulation. This can be done to decrease the supply of a certain cryptocurrency, increase the value of remaining coins, or meet certain conditions of a token sale. When coins or tokens are burned, they are usually sent to an address or contract that can't be used, so they can't be transferred or used anymore. Burning can increase the scarcity of a cryptocurrency, making the remaining coins more valuable, but the burned coins are gone for good. It's important for investors to consider the effects of burning before making decisions.